Hello and welcome to the Small Business Briefing. I'm Brian Calley, the CEO of the Small Business Association of Michigan.
Good afternoon, everyone. Thank you for joining us today. I'm Sarah Miller. As we get started here on this Monday, we want to say welcome to one of our new members, Hoyden Creative Group, located in Addison. Welcome to their CEO, Molly Mason, and team. And we are welcoming our sponsor or our member on behalf of our sponsor, Consumers Credit Union. Remember, if you're in the Kalamazoo area, we'll actually be at Consumers Credit Union this Thursday for an SBAM owner-to-owner networking event. So be sure to check that out if you can. So, Brian, there's been a lot of banking talk in the news, especially over the weekend, and you've invited a special guest from the Community Bankers of Michigan to join us today.
Yeah, thanks, Sarah. So today we're honored to have a special guest, and it is Mike Tierney, who's the CEO of the Community Bankers of Michigan. And we thought it was important as we see all of this happening, really some things that haven't happened in a while in the banking industry that have created some questions in people's minds. And we wanted to invite in a friendly association, the Community Bankers of Michigan, which is headed by Mike Tierney. And we'll just talk through some of these issues. So Mike, thank you for joining us today. And I bet it's been a pretty busy several days since news broke about Silicon Valley Bank. And yet, really, probably, well, it's a big deal what happened there. Not really indicative of the market per se. Certainly not here in Michigan. So first, welcome to the Small Business Briefing. Thanks for making time. But I thought maybe we could start out, maybe do a little level setting with us in terms of what happened with Silicon Valley Bank, and maybe give us a little bit of insight about how really far outside of the mainstream this bank was. In other words, not like a regular bank that most people would have any kind of dealings with.
Silicon Valley Bank was a specialty bank. They focused on the high tech and venture capital industry. They had a very unique business model and a real heavy concentration, as we're all aware of now, in a kind of a vertical in an industry. And, the banks and credit unions in Michigan are nothing like that. All of them are generalists. Their deposits come from everywhere in the community. They come from retail customers. They come from small businesses, mid-sized businesses, healthcare, municipalities. So it's very diversified, and you don't have, one industry was hit really hard, started pulling the money, and, that just led to whispers throughout the industry, and $42 billion went out of that bank in 2 days. And there's no bank in the country, there's no credit union in the country that can withstand, all that money is invested in the communities. It's in loans out to individuals and businesses. And so banks are very liquid. Credit unions are very liquid. They can handle all normal kinds of ins and outs, and they're ready for 20% kind of surprises, but not when such a large part of your business rolls out. And the same is true for Signature Bank that failed in New York. They were a crypto bank, pretty heavy in crypto, and they've had liquidity issues for months. It wasn't brand new. It's been coming their way ever since the FTX crash.
So that is I think, an important distinction, and really something a lot of small business owners would understand, that there's higher risk when you have concentration. So, a business might have concentration in a customer. Something bad happens with that customer, it can create more risk than if you're well diversified. So in one case, concentration in crypto business, but also in Silicon Valley and technology. So let's talk a little bit about there's a lot of cash that the federal government kind of put into just out there into the ecosystem. And so banks were pretty flush with cash in 2020, 2021. And of course, those assets get invested someplace, bonds and loans if there's loan demand. And in this case, you had it seemed like kind of a perfect storm where the Federal Reserve was increasing interest rates at a time when the technology sector was really tanking. And so tech companies had to use a lot of their liquidity, pulling some assets out. The bank had to cash in their bond portfolio at a time when interest rates went up. So the net present value of those investments were lower. And it was just kind of one hit after another. That led to a pretty quick withdrawal of cash from that bank, as you mentioned, $42 billion basically in overnight within 2 days. So in terms of what would you expect in terms of the response? So we've seen some response today already from the federal government to try to provide Americans just with confidence in the banking system. What did the president announce today, and what is the regulators' kind of initial response to the Department of Treasury?
I think they took the steps they had to take yesterday to make all depositors whole of both Silicon Valley Bank and Signature Bank. So they guaranteed that every dollar of deposit, whether it was insured or not, would be repaid. And I think that has calmed things down quite a bit. The second thing that maybe some of your members aren't aware of, the Federal Reserve also came out yesterday with a program for all banks, all credit unions in the country, where they can access liquidity through the Federal Reserve. So these securities that a bank or a credit union may have that may be underwater because of the rapid rate rise, they'll be able to use them as collateral at face value, not at current market value, but at par wherever they bought that security. And so that's going to plug this gap for any entities that had bought securities when rates were low. When those securities mature, they're going to get all that money back. They're going to be fine. It's just a matter of, in the meantime, these are securities they never meant to sell. And as long as there's not a run on the bank, they won't sell them and they won't recognize that loss and everything will be fine. But by doing this today, they ensured that, most banks are fine. There's still 2 or 3 banks that are very specialized, that are very focused on the high-tech business, and they are taking it really rough in the stock market today. But it'll probably be limited, to that. And I think even those banks have taken the steps now that they will, I wouldn't be surprised if they're sold sometime, in the next 6 months, but they will probably make it through. So I think this has been contained, and I don't think business owners, particularly small business owners in Michigan, need to be concerned. So every bank and credit union deposit is insured up to $250,000. So that, for most small businesses, they're fine. And in almost every case, any community bank in Michigan or any credit union will be merged into another entity and no dollars are ever lost. And that was true, in the last cycle. Every bank that failed in the last cycle was bought by another bank. All those deposits were honored. Every credit union that failed was bought by another credit union. All those deposits were honored. So I don't see, the Michigan banks are in incredibly strong position, much better position than banks were in going into the 2008 recession. So we don't see any issues on the horizon here for any of the businesses that do business with community banks or credit unions.
Excellent. Well, I really appreciate the perspective, Mike. Thanks for coming on in short notice and providing the insight. And we'll look forward to seeing how this plays out. But as you had just laid out, we thought it was important to make sure that people understood that the banking industry is strong, that there's a regulatory framework around banks. So what we're seeing happen in these specialty banks is not indicative of the market, and as to provide additional confidence, the feds are stepping in to make certain guarantees, and really there's already a system that we should have a lot of confidence in, is now bolstered even more so. Mike, thanks for joining us today.
All right, thank you.
All right, so yeah, it's interesting, Sarah, as this plays out. Having been in the business, my first career was in the banking industry. I spent about 10 years in the business, and I serve on the board of a couple of community banks now. So very, very well versed in the industry. And what the feds have done now, when they stepped in to number one, guarantee all of the deposits from these two banks, even if the balances were over 250,000. And they're going to do that out of the FDIC, essentially the FDIC insurance premium dollars. So they won't be asking Congress for a bailout or anything like that. But the other thing that they're doing, which I think is more important, and Mike had alluded to this, is that what they're saying is that, hey, banks, if you've got a liquidity problem because you've got these investments in bonds and interest rates went up, so the net present value of your bonds went down. As long as you can hold those bonds to maturity, you never take a loss. So if you're having liquidity problems, what the feds are saying is, hey, you can borrow from the Federal Reserve banking system, and you can do it on the face value of your bonds, not the present value. And then you just have to hold the bonds till maturity, and then you cash them in and never actually take the loss. With Silicon Valley Bank, where they really got hit was that they had liquidity needs right now, and they had to cash in those bonds, and they ended up taking a huge loss on those bonds, which spooked investors, and there were other things that were, kind of, as Mike had mentioned, kind of whispers in the industry, which really led to a run on the bank. And $42 billion is a lot of outgoing deposits, especially when those deposits are wrapped up in loans to other entities and things like bonds. So we wanted to just give some level of confidence to folks that this is that the banking system, regular banks that are less concentrated, are not in anywhere near the same type of scenario that Silicon Valley Bank was in.
All right. Yeah, it was really good to hear from Mike, and glad he could join us last minute here. So on Thursday's show, you kind of previewed that we'd be expecting a jobs report, and that was released on Friday. Any surprises?
Well, it was, I would say that it was about on par with what was expected. So 311,000 jobs nationwide is a national jobs report that came out, is on the heels of the previous month, which is about 500,000. So it is fewer. And I know that it's weird to say that fewer is good news, but when you're battling inflation, that's really what policymakers were looking for, although in terms of the Federal Reserve, but still kind of high. It would still be defined as a hot jobs market. The mixture of where the jobs come from, and we'll cover that on the Data Monday report, was a little bit surprising to me. But the overall level of jobs, right on par with what was expected, which was not really going to give a lot of confidence that inflation will ease anytime soon.
And when we talked about this last week, it was in relation to the Federal Reserve. So what are the interest rate implications here?
Well, I think it's further interest rate increases are in our future. Now that was already going to be the case. 0.25% increases for the next few meetings, at least, was what was expected. But the chair of the Federal Reserve had set some additional expectations that there would be half point or even 3/4 point increases still yet in our future. And looking at the jobs report, I would say that that it's kind of like on the bubble. I won't be surprised at all if we see half percentage increases in the Fed funds rate. And when we were expecting just a few months ago that it would be down to 0.25% and then flat for a while before rates start coming down. Now the markets, they predict these things, and they are predicting. Many of the predicting models are still looking at toward the end of the year, beginning of next year, would rates start to come back down, but time will tell.
All right, it's actually a double guest day today, which is really exciting. We are welcoming one of our Leadership Council members on. So Brian, I'll let you introduce her.
Yeah, very good. So I wanted to introduce Jen Jurgens, and she is, Sarah mentioned, on the Leadership Council, one of our most active members of the Small Business Association of Michigan. So Jen, thanks for coming on the show, and we're going to talk about some content that you created for us. We love to get content, thought leadership from our members, like real small business owners, to share with the broader small business community. But before we get to that, One Bold Step, your business. Tell us just a little bit about that.
All right. Well, thanks for having me on the show today. Always fun to talk with you both and the other members. One Bold Step, we started in early 2019 with the idea that we could be in a marketing agency, but differentiates in that we're really big on creating very strategic annual plans for our clients, and we don't stop there. So we create the plan, and then what we'll do is we'll come in and we'll fill any of the gaps that the client may have in executing that plan with our fractional marketing team model, which aligns actually quite well right now, Brian, with your report on jobs, because people don't need necessarily, a 5-person marketing team, but marketing skill sets are very different and unique these days with the intersection with technology. So with us, you can get 5% of a CMO and 10% of a digital campaign manager, so forth and so on. And one of those areas that we really lean into is systems. So we're a CRM and marketing automation integration specialist, and we're also a Platinum HubSpot provider.
Very good. Well, those, the fractional concept is one that's so important for small businesses who don't necessarily grow in FTE increments, not need a full-time person. And when you get to that, especially those leadership strategic levels too, fractional services have been so important. So we're going to share in the comments the article that we're going to talk about here. It's titled "The Economic Outlook: Should You Dial Your Marketing Up or Down?" It touches on the impact of the pandemic and some of the subsequent economic factors, and a lot of crosswinds out there in the economy today. So maybe just talk a little bit about how you got your own business and you do marketing, but how you approach this during those times, and as you're heading into still some kind of uncertain economic times.
Yeah, well, one of the things that we do first with every single client is we have what we're now calling more of a workshop, but the output is that annual strategic marketing plan. And the only way that works is if we get everyone to weigh in on the plan. So of course they're going to buy in on what the end result is. That became so hard when we were all stuck at home. So what was a one-day session became a 6-week session, breaking it down into manageable Zoom calls in order to get the same amount of information without people just falling asleep on us, because no one can sit in a Zoom call for 6 hours, right? So it stretched out what we were doing. And in that, we had to really get lean. So looking at everybody's skill sets so that we could sort of backfill where they could fill in on different teams, because it was taking so much longer to onboard new clients. So that was one of the things that we did. The other was we really leaned into agile project management, where one of the facets is that there is this absolute transparency in project management. So we took on some tools like Asana, which allows us to manage all of our projects with our clients in a remote setting, very visible, very transparent. And then also Slack. And we've basically used, Zoom calls where we still do it, even though we get together. We have a hybrid environment now, 2 to 3 days a week at our office. But we have Monday and Wednesday mornings, we do our stand-up via Zoom, where we share just the top 3 things we're doing for the day. So little by little, we've kind of just taken well-known, I would say, methodologies for getting work done and tried to transition those with some technology.
So in your article, you talk about this, treating your marketing like it's an on-off switch as compared to, say, a dial. And I wonder if you could maybe just give some practical application to the differences between those and the approach. You put a little color to that.
Yeah, it came from, I worked for a technology company a few years ago, And one of the owners would pop his head into my office and say, "Is the marketing on?" And I would say, "Yes, yep, the marketing it's on." And what I was trying to reflect there is it's not a switch. You know what I mean? It's not on or off. He might have been referring to advertising, you know what I mean? Like a specific campaign, but marketing, because it is about more than just promotion. Remember, product, price, place, those are all parts of it, that I wanted my team to think of it as a dial, so that when we're going into times of plenty, we crank that puppy up. And maybe when we're going into, recessionary or tighter times, we sort of dial it down, but it never turns off. There are things that you should be doing in good times. There are things that you should be doing in bad times, but you should always be doing the marketing. So that was really the point behind it. And we went so far as to make a fun little dial that we hung up on the wall so that we could say, yes, it's definitely on. It's just higher today than it was yesterday.
Yes, right. And there's so many different facets and different things. Maybe some are more necessary than others. Some are nice to have when you've got the revenue. Some things are absolutely are essential. Now, data-driven decision making, it's that's certainly best practice in almost any business these days. Maybe give some like how would somebody leverage data or information to make these types of decisions?
Well, anymore, the majority of marketing is digital. To say that again. So I don't have a traditional marketing background. I have a supply chain background. And to me, marketing and sales, it's a process. And if you're a Peter Drucker fan, like those of us who went to supply chain school, you have to measure it to manage it. And so this transition of marketing to digital has enabled almost to some points too much tracking. But I can tell you that we group together things inside of campaigns. We use marketing automation platforms so that we can see who opened, who clicked, who completed the form, who visited which web pages and when and how long they stayed on them. Those kind of gets into that creepy marketing that we try not to do. But I can tell you that we test offers against each other in outbound emails. We test offers against each other in digital ads or social posts. But I think at the end of the day, the thing that every marketer should know is that it's never just one thing that makes a campaign successful or not. It's all of the things. And so having something in place that allows you to do that level of tracking is really what allows you to be lean in your marketing.
So somebody's looking to get started, especially, I know a lot of companies that you start out and it's kind of like the friends and family plan. You've got the people that you've got your first clients that you have, but then you get to a point where you've exhausted that and you really need to get beyond it. Where if somebody's at that point where they've never really done marketing, never turned it on, if you will, it's been more of the of what kind of organically happens in their world, whatever their sphere of influence is. How do you where do you get started? What do you recommend for somebody getting started?
Well, there's so many clever and creative things that you could do. But where I always start is, where is your business going? Where do you want your business to go in the next 12 months? And I typically try to break that down because I have to systemize everything and organize it. But I try to break the focus areas of the company down in like 3 to 5 buckets. And then underneath that, then I come up with what can marketing do to help you achieve those business goals? Because marketing has to be aligned with where the company is going. Or what you're going to find out is maybe you had a successful one-off campaign. Now what? Or, you know what I mean? Or maybe you started to do something and then it didn't really fit with the priorities and you ended up being focused back on running the business, and that just sort of died out, which I see very often. So the very first thing that I would do is make sure that you try something that is directly related to where you want the company to go. And if you want me to get specific, I'll throw this out there. I still love a good educational outbound email campaign where you're not selling anything. You're giving away your information, your data, what you've learned for free. And that's just a really easy way of drawing people to you. So I'm here to say email's not dead.
Yeah, all right. Very well. Actually, I'm glad to hear that because that's actually something that we giving away, particularly content, thought leadership is one of the things that we lean into at SBAM, and it's amazing how much energy that it creates.
Everyone at our company has a goal of writing at least one educational blog per quarter. And so we just continue to give that knowledge away. And that draws more people to us, I think, than, special offers or one-offs. People want anymore to learn about a company before they engage with them. So your best bet is to answer their questions before they ask them.
That's an awesome insight. Thank you, Jen, for joining us. The Business One Bold Step. The link is in the comments if you'd like to take a look, and you can find and learn more about Jen and her business through that article as well. Thanks for joining us today.
Thank you. Have a good one.
All right. Yeah. Thanks, Jen. That was really helpful for our viewers. So, Brian, real quick, the legislature we know was really active last week. What can we expect to happen this week?
Well, we're going to see, we'll see right to work, the idea of compulsory union membership pass through the Senate and be sent off to the governor, where I think it'll get a quick signature. Prevailing wage, same thing, the return of prevailing wage in Michigan. So those things will come to fruition. There'll be some other things, some other non-business issues that run through the process as well. But I think that's really all attention is going to be on those two policies this week in the legislature. And much as I hate to say it, I think it's a foregone conclusion. It'll pass the Senate. I think it'll pass the Senate relatively easy. It will not get immediate effect, which means it won't go into effect until next year, but it'll hit the governor's desk soon, and she will most certainly sign them.
And of course, we'll have an update on that during Thursday's show. All right, so let's take a look at today's Data Monday report.
All right, we are going to do lightning round here. Just to get an idea, Silicon Valley Bank, I wanted to give you a sense for how big the bank is relative to other bank failures going back to 2009. So if you want to know why this one has gotten so much attention, this is why. Second only to Washington Mutual, but a specialty bank, again, not indicative of the banking industry as a whole, but it was big, about a 40-year-old bank. All right, let's talk about the jobs report. Here's where you see 311,000 jobs. You can see how it stacks up as about 500,000 the month before. If you're to look at this, you can kind of see a downward trend there, but looking more flat than downward. Compare it to pre-pandemic times, you can see still high, and that's why there's not confidence that inflation will be under control anytime soon. Where those jobs came from: 105,000 from leisure and hospitality. You got retail at 50,000. So some two that are very much small business driven. We're actually pretty big in the overall growth. Although you're going to see in a few slides that a lot of overall small business new hiring is actually starting to fall down a bit. Consumer price index in January 6.4%. Growth in hourly earnings annual for the last year has been 4.6%. So still not keeping up with inflation. Take a look at this down here. Manufacturing actually down. So overall, jobs report hot, manufacturing down. Looking at the U.S. employees and non-farm payrolls by manufacturing, you can see where that negative 4,000 that I just showed you, but this is after a stint of many months in a row of growth, but see how that's been trending down and actually went negative. Then looking at U.S. employees on non-farm payrolls in the information technology sector, and look at how that's trailing off. Again, Silicon Valley Bank, that industry, look at what's happening to payrolls there. And then the quit rate and the jobs opening rate, you'll see that is Both of those are still historically high, but off their peaks. So I guess that's sort of good news that they're off their peaks. But the quit rate is still high, and the jobs opening rate is still high. This is what I was talking about in terms of small establishments. ADP, the payroll company, puts out stats and nationwide stats, and you'll see that for smaller establishments, that payrolls overall starting to come down. You can see up here, not by a lot, but you definitely can see it now. And then long-term unemployment, 17.6% of those unemployed have been unemployed for 26 weeks and over, or 27 weeks and over. That means more than a half a year. And then here's the bright spot: labor force participation rate up a little bit. Actually, mainly because of an uptick in women in the labor force that had dropped down a little bit and now has come back up, which has pushed the average back up. Labor force participation at 68% among men was up about 0.1%. So that was basically flat, but overall, 62.5. Michigan's stuck at about 60%, but the nationwide numbers, like I said, just a bright spot. Unemployment rate, which these days with the labor force shortage like it is, doesn't mean as much as it used to, but 3.6%, been pretty stable at that level. The unemployment, this is looking at the number of temporarily unemployed and the number of, in other words, laid off for a temporary period of time, or jobs just completely eliminated. And you see both of those pretty low. And then average weekly hours for leveling off, and for the month a little bit down, which have been a bit of, probably the Feds would look at this as fairly positive data for inflation in the future. And look at this stat. This is my favorite one of the entire Data Monday. 25 national or NCAA appearances over the last, since 1998. And that 1998, that was the year I graduated from Michigan State. Started off quite a beautiful thing there. So that's what we have today with our Data Monday, and we'll look forward to having some guests up on Thursday, which will be get this, will be the 3-year anniversary of our first small business briefing. Really the depths of the pandemic, totally different circumstances, but here we are 3 years later.
It's hard to believe 3 years have passed since that day in March, but here we are, and we are looking forward to Thursday's show with some special guests. Thanks for joining us today, and be sure to tune in on Thursday.
See you on Thursday, everybody.